Another expert hour by Crow, brought to you by MICCI. Hello there. I'm Sean Chia, the Executive Director of the Malaysian International Chamber of Commerce and Industry. Longest established chamber in Malaysia, championing businesses since 1837. We are more than 180 years old. Are we tired? No, we continue to keep our members up to date. And this is another part where we are bringing knowledge and sharing with our members. Before we start, some housekeeping rules. Those that are on Facebook, if you have any questions, please do put it into the comment section and we will try to answer that. And those that are on the Zoom, the questions can be put on the chat box. Without further ado, today's topic is a update, the latest update and developments on transfer pricing. We have done the transfer pricing webinars some time back, and there are some very interesting new things that is coming on board. So today's key highlights is some of the latest IRB guidelines. There's some changes on transfer pricing documentation, transfer pricing issues, often challenged by the IRB, the Inland Revenue Board, and it's about sharing some life experience on this transfer pricing audit. Since the last time we had this webinar, there's a lot of water that's gone under the bridge, and there are a lot of new learnings, and Crow is sharing that with you. So at the end of the day, it's about what can taxpayers do to minimize this transfer pricing risk. There's also some new penalty regimes and several changes that came about since 2021. In this live Zoom webinar, we have from Crow Transfer Pricing Executive Director, Ms. Sylvia Fong, having 14 years in tax and specifically transfer pricing experience, involving a very broad spectrum of the industry and businesses. She's a member of the Association of Chartered Certified Accountants, ACCA, the Malaysian Institute of Accountants, MIA, Chartered Tax Institute of Malaysia, CTIM. She's also a licensed tax agent and a certified HRDF trainer. So I'm sure you're all very waiting to hear from Sylvia. So without dragging on too long, Sylvia, are you ready?
Yes, sure.
Okay, the floor is over to you, Sylvia.
Thanks, Sean, for the introduction. Good afternoon, ladies and gentlemen. I'm Sylvia, and I'm the speakers for today's webinar. Just let me share the screen. Right. Okay, firstly, I would like to thank MICCI for inviting me to speak on this topic on the latest updates and developments on transfer pricing. It's very specialized topic, on transfer pricing that covers a group of companies, right? Okay. So today's briefing, I will be covering the transfer pricing compliance requirements. What do you need to do to comply with the TP requirements in Malaysia, and the latest updates on the Form C, the corporate income tax return for year 2022. There are additional disclosure on the control transactions, for TP purposes that you need to disclose in the Form C, and what are the challenges, that you need to take notes of. And I will also be sharing with you the recent TP audit issue that challenged by the IRB. These are the common issues, and what will be the issues that most commonly raised by the IRB during a TP audit. Okay, and at the end of this session, we will have 50 minutes of Q&A sessions with the audience. If you have any questions, please post that into the chat box. Okay, I have also received 2 questions during the registrations from the participants, and I will address these questions throughout my briefing. The first question is, what is the directions of IRB on transfer pricing and the rationales behind the latest changes in the Form C on transfer pricing? So we understand from the IRB officers that they will focus on transfer pricing, as you see that they have been putting changes in the Form C for more completeness of a disclosure on the control transactions, yeah, for your entity. And the IRB encourage compliance for of the taxpayer to comply with the transfer pricing requirement in Malaysia. Yeah, so these are the directions that the IRB wanted to encourage compliance from the taxpayer. And second question is how to deal with interest-free advances between group of companies in Malaysia. I will address these questions in my later sessions. I will have a sessions on interest-free advances. Yeah. Okay. So first start with the latest changes on transfer pricing. What are the compliance requirements? Yeah, I guess most of you would know, yeah, who is liable to prepare a TP documentation. This is not new, but it has been in the guideline and we have been repeating this requirement, yeah, a lot of time to the taxpayer to ensure compliance, yeah, from taxpayer to prepare the TP documentations, yeah, for your entity. So this transfer pricing documentations is required for companies that undertake control transactions, meaning to say related party transactions. So if you have a group of companies, yeah, whether it's within Malaysia or cross-border transactions that you have with the overseas companies, yeah, within the group, and you have undertake some control transactions, related party transactions with your related companies, by all means, including sales, purchases of goods or services, yeah, any intra-group financing, yeah, your intercompany loan advances, yeah, that you obtain or you provide to your related companies, or any use of intangible properties, yeah, royalty, licensing fees, yeah, or any management fees that you pay or receive. So all these transactions will fall under control transactions within the group that you need to prepare a transfer pricing documentation. But of course, when it comes to a type of documentations that you need to prepare, you can refer to the threshold. So in Malaysia, we have a threshold set in the Malaysia transfer pricing guideline. Yeah, so if you fulfill this threshold, you meet the threshold set in the guideline, you need to prepare a comprehensive full TP documentations. Yeah, so a full TP documentation is required when a company has annual gross income exceeding 25 million and total related party transactions exceeding 50 million per annum. So the assessment on this threshold is per entity. Yeah, it's on entity basis. So you need to assess for each of your entity within the group whether you have an annual gross income, which is your annual turnover for more than 25 million, and your total related party transactions. Yeah, you have to total up your sales, purchases, services that you pay. Yeah, so all these, if it is exceeding 50 million per annum, you have to prepare a full TP documentation. So on top of that, the IRB has also assessed, yeah, the provisions of financial assistance, which is the intercompany loan or advances. Yeah, if you provide any intercompany loan and advances for more than 50 million, yeah, you have to prepare a full TP documentation. But if your transaction is below this threshold, yeah, it does not mean that you don't have to do anything. You still have to comply with the arm's length principle and prepare a limited TP documentation, yeah, if you fall below the threshold. So this is the requirement from the IRB stated in the guideline. So there is some update from the IRB flowchart, yeah, in December last year. So this flowchart has a easier understanding, yeah, a better understanding for you to ensure whether you are required to prepare a TP documentation. So first you have to see whether you are a person, yeah, carrying on a business, having a control transactions. Yeah, if your business are all dealing with third parties, you do not have a transfer pricing issue. Yeah, only for a person which is a company that having a control transactions within the group, yeah, then you have to look into this transfer pricing. Okay, so if you undertake control transactions, yeah, we have segregated into domestic control transactions or cross-border control transactions. So if your transactions is with a cross-border related companies, yeah, you will have to see whether you meet the threshold that I explained. So if you have exceeded the threshold, you have to prepare a full TP documentation. But if it is below the threshold, you just have to prepare a limited TP documentation. But whereas for a domestic control transactions, there are some sort of exemptions given by the IRB. So if you look at this red box, these are the conditions that you need to fulfill in order for you to be exempted from prepare a TP documentation. So you have to ensure that the transactions that enter into for a domestic control transactions, both parties are chargeable to tax at the same rate. Meaning company A and B are in Malaysia, you are paying the same tax rate in Malaysia. For example, 24% you are paying, or both companies are not chargeable to tax due to the parties enjoying tax incentive for suffering from continual losses. You are not paying tax, both parties are not paying taxes, and the effect of the transactions would not result in adjustment that will alter the total tax payable. So if you can fulfill these conditions, you do TP documentation is not required. You can be exempted. If your transaction is solely with domestic and you fulfill these conditions, then you don't have to prepare a TP documentation. I will give you some example later on what type of transactions that will be subject to documentations to which is required, and which are the situations that you can be exempted. So some of these examples for companies having domestic control transactions that require to prepare a TP documentation. Not all domestic control transactions can be exempted. You have to look into the tax position as well as the transactions that you are undertaking. So for example, company A and B are both in Malaysia, transacting within Malaysia, so we call it as a domestic control transactions. So company A is a non-chargeable tax to tax. So company A, assuming they are loss-making, company B is also loss-making. So both companies are not paying tax in Malaysia. So if the tax losses are not sufficient, any TP adjustment made by the IRB will not be fully offset by the tax losses, and hence it may result in additional taxes payable by company A or company B. So in this case, it means that the adjustment made by the IRB will alter the total tax payable, and therefore you have to prepare a TP documentation. Because your tax losses is not sufficient to cover the adjustment made by the IRB. IRB will still make adjustment if they find that the transaction is not conducted at arm's length. So this exemption is only given to taxpayer that fulfill the conditions. You are not required to prepare a TP documentation, but doesn't mean that IRB will not make adjustment. When it comes to a tax audit, IRB will still look into the related party transactions. If the IRB find that your transfer prices is not at arm's length, IRB will make adjustment and impose a surcharge on that. So if any adjustment made that give rise to additional tax payable to the company, that is where it will alter the total tax payable, and therefore you will have to prepare a TP documentation in this case. Unless you have significant tax losses that can be utilized, fully utilized, all the adjustment made by the IRB. So in situations 2, where company A is taxable, company B is loss-making or enjoying incentive, therefore is not paying tax, non-chargeable to tax. So in this case, any TP adjustment, TP stands for transfer pricing, any TP adjustment made by the IRB on company A will likely result in additional tax payable by company A. So in this case, you will have to prepare a TP documentation as well. So because the tax is not neutral, in Malaysia. So third example, both company A and B are taxable, and assuming they are subject to the same corporate tax rate, in Malaysia. So any TP adjustment on either company A or B will result in one company paying additional tax, and the other company will be receiving a corresponding tax reduction. So in this case, we call it as a overall is a tax neutral. There is no tax loss to the IRB and no difference in the net tax payable positions, or no tax loss revenue to the IRB. So in this case, no TP documentation is required to be prepared. Yeah, so you have to ensure that you fulfill these conditions in order not to prepare a TP documentation in Malaysia. So in cases where both companies A and B are taxable at the same tax rate, but yeah, if the transactions that you are undertaking, yeah, will have any changes, yeah, will alter the total tax payable, you have to be careful, because if the control transactions involve a financial assistance arrangement between the related parties A and B, yeah, and any TP adjustment on interest expense or interest income may not result in a tax neutral positions. If the borrower party is subject to interest restrictions, you may not be able to claim full deduction, yeah, under section 33 sub 2, where the interest expense of the borrower is not fully deductible. So in this case, it's not tax neutral. Yeah, the lender will be fully taxable, but the borrower will not be fully deductible. Yeah, under this interest restriction rules. So in this case, if the control transactions involve financial arrangement that will alter the total tax payable, yeah, if the IRB make adjustment on the deemed interest on this financial assistance, yeah, that will subject to interest restriction rules, then you will have to prepare a TP documentation because the position is not neutral. Yeah, so there will be a tax loss to the IRB. Yeah, in this situation. So you have to be careful when you assess whether your company can be exempted in preparing this TP documentation in Malaysia. Yeah, and to my opinion, it's difficult to decide, yeah, at this point of time, because you wouldn't know what type of transactions or adjustment that the IRB will make during a tax audit. So my advice is that it will be good, yeah, to prepare a sort of a documentation, TP documentation, to document your transaction and to justify the pricing that you transacted between your related parties. So when we talk about part of the conditions is that no alterations of total taxpayer, meaning to say that there's no difference in the net tax payable position and no loss of tax revenue to the IRB. Okay, so you have to assess this position before you decide whether can you be exempted, yeah, from preparing a TP documentation in Malaysia. But having said that, penalty will still apply. Yeah, section 113B is the new introductions of these sections, effective from 1st January 2021, last year. Yeah, a new penalty between 20,000 to 100,000 for failure to furnish contemporaneous TP documentations to the IRB. So if you are required to prepare a full documentations or limited documentation and you did not prepare this documentation upon a transfer pricing audit or a tax audit, IRB will request this report and you do not have this TP documentation to be submitted within 14 days to the IRB, IRB will impose a penalty between 20,000 to 100,000 per year of assessment. Yeah, but if your entity fall under the exemption, yeah, you are not required to prepare a TP documentation because you fulfill all the conditions. Therefore, this penalty will not be applicable to you. Yeah, it will not be imposed on the taxpayer who are not required to prepare. Yeah, but having said that, surcharge under the new subsections 140 capital A sub 3C, the surcharge of not more than 5% on the TP adjustment will still be applicable, yeah, whether or not you are required to prepare a TP documentation. Yeah, as I mentioned earlier, the exemption is just for preparations of TP documentation, but you still have to comply with the arm's length principle, yeah, on your transfer pricing. So if you do not comply with that and IRB view that your transaction is not at arm's length and make adjustment accordingly, a surcharge will be imposed, yeah, of more than 5%. Okay, when do you need to prepare a TP documentation? A TP documentation should be prepared and is regarded as contemporaneous, yeah, under the following circumstances at the time a person is developing or implementing any control transaction. So before you enter into a transaction, before you charge your related company, you should prepare a TP transfer pricing documentation, yeah, to set up your transfer prices appropriately, yeah, when before you enter into a transaction. So subsequent to that, you have an annual review of your existing TP documentation prior to the due date for filing of your tax return, yeah, which is your Form C on a year of assessment. So because in your Form C, you need to declare, yeah, in your Form C, whether you have prepared a TP documentation place. So you need to have an annual review and update your TP documentation before filing of your tax return. So for example, if your company year end is 31st December 2021, your submission deadline for Form C 2021 will be due on 31st August 2022, which with a 1 month grace period. Yeah, so you have to prepare this TP documentation, get ready your documentation before submissions of your tax return, yeah, in order for you to declare a yes, yeah, in the tax return. So, and these informations in the TP documentation, yeah, in particular, the financial data and suitability of the comparability and comparable companies of the benchmarking analysis, yeah, should be reviewed and updated every year in order to comply with the arm's length principle reliably. Yeah, because every year the financial data will change. Yeah, the financial result will change. So you need to have a annual update on your TP documentation to ensure that it reflect to the latest financial data of your entity as well as the comparable companies to ensure to ensure that your company is still fall within the arm's length principle. So in addition, a company is required to update the full set of documentations with a fresh search of comparable companies through a benchmarking study every 3 years. So the IRB is saying that in the guideline, the IRB has stated that for the benchmarking study, you should be preparing and renew, yeah, your benchmarking study every 3 years. So you have to update your financial data every year, and every 3 years you need to prepare a new set of benchmarking. So I give you an example over here. Let's say your year one in 2019, you have prepared a documentation with a new benchmarking study. Yeah, and subsequent 2 years, you just have to update the documentation with a financial update of your benchmarking analysis. Yeah, but on the 4th year, which is every 3-year cycle, yeah, you need to prepare a new search of the benchmarking analysis. So this is the requirement, yeah, that's stated in the TP guideline in Malaysia. So what are the contents in the TP documentation that you need to be included, yeah, in order to comply with the TP guideline? So a good quality TP documentations that complies with the TP guideline shall include the following contents. So these are the contents of documentations to be included in a full TP documentation as well as a limited documentation. So for limited TP documentation, you just need to document these 3 items. Yeah, mainly the group overview, the background informations, yeah, the business model, the group structure, the control transactions. You have to explain, yeah, the type of control transactions and the amount and who do you transact with and how is the transactions take place? How do you charge? What is the charging basis? What is the pricing policy? Yeah, if you have a comparability study to justify how is the pricing being set, yeah, that has to be documented properly in the TP documentation. So this cover the limited documentation, but a full scope of TP documentation is very comprehensive, that you need to include an industry analysis. Yeah, how is your industry doing during that period? Yeah, and whether your performance is consistent, yeah, with the industry trend, yeah, during the financial year, and your functions performed by the company, asset owned by the company, as well as the risk assumed by the company. This will help to characterize your entity, whether you are a full-fledged entity or a limited risk entity, yeah, in Malaysia. And you will also have to select the appropriate TP method, yeah, to test your transactions, whether is it conducted at arm's length and how do you apply this method. A benchmarking analysis is required, yeah, if you were to apply, yeah, any of this TP method, you should perform a benchmarking to support your transaction as well, and a financial analysis, yeah, to see how is the company financial result, yeah, for for the period, yeah, for the cover period. So if the company is a loss-making positions, you have to justify why the company is making losses, yeah, with the commercial reason to ensure that your losses is not due to inappropriate transfer prices, but it's due to any commercial reason, yeah, for your business. So we effective from 1st January 2021. These are some of the new changes, yeah, the introductions of new sessions 113 capital B on a new penalty between 20 to 100,000 for failure to submit the TP documentations to the IRB within 14 days. Yeah, even though the IRB may grant an extension of time to the company to submit the TP documentation, but the IRB, even if the extension of time is being approved, the IRB may still impose this penalty, yeah, under section 113B because you fail to submit due to the original timeline of 14 days. Okay, and the IRB has also updated in the TP guideline that the submissions of a TP documentation has shortened from 30 days to 14 days. Yeah, so if you fail to submit within 14 days, that's where a penalty can be imposed on the company. Yeah, and as I mentioned earlier, the new section 3C, yeah, which is the surcharge, the new surcharge, yeah, will be imposed for any cases, yeah, that the IRB open for audit after 1st January 2021. Yeah, even if let's say the audit period is prior to year of assessment 2021, but the IRB can still impose this new surcharge of not more than 5% on the TP adjustment. Yeah, if the audit is being carried out after year 2021. Okay, so regardless whether the company is a tax payable position or not tax payable position, whether the company are making losses or the company are enjoying incentive and not paying any tax, this surcharge will still apply. Okay, so recently we have a case, yeah, that we are just negotiating with the IRB this week, that the IRB has imposed a 5% surcharge on one of the loss-making entity, yeah, that result in quite significant surcharge amount to be paid. So even though there's no additional tax, yeah, on the adjustment made by the IRB, because the company has huge tax losses to be utilized, yeah, to set off all the TP adjustment that made by the IRB, but the IRB will still impose a surcharge of 5%, yeah, on the adjustment made, yeah, and the company is liable to pay this surcharge, yeah, to the IRB, because this surcharge is not allowed to set off against your tax losses or any incentive, yeah. So that will be the additional burden, yeah, to the company, especially loss-making entity. So there is also another new section of capital 140 capital A, sub 3A and 3B, where it empowers the IRB to disregard the structure in a control transactions and make TP adjustment to the structure that the IRB thinks fit. So this has put in the act, yeah, that the IRB has the power to disregard any structure, yeah, undertaken within the group if the IRB think that your structure is not appropriate, yeah, or it thinks that the structure is not aligned, yeah, with the substance over form, and this will be challenged by the IRB, and IRB can make adjustment to the structure and impose, yeah, additional taxes and penalty on the company itself. So IRB has also updated in the TP guideline that penalties will not be imposed in cases where a TP documentation is of good quality in accordance with a TP guideline, and upon request by the IRB, taxpayer have submitted, yeah, the TP documentations within 14 days. So if this has been fulfilled, IRB has stated in the guideline that penalties will not be imposed. But based on our experience, in most cases, IRB will still impose a penalty, but there's some room for negotiations with the IRB on the penalty rate. Okay, so give you an example on how the new surcharge and penalty will be imposed by the IRB. So let's say the parents company have a transactions with the subsidiary company in Malaysia, and the subsidiary company is making losses in Malaysia and no local TP documentation prepared for the year 2014 to 2019. Yeah, so IRB commenced the TP audit, yeah, after 1st January 2021, auditing the period from 14 to 19. Yeah, and the TP adjustment made by the IRB, for example, is 5 million. So, however, the subsidiary has no additional tax payable as it is in a tax loss position. Yeah, and you can utilize all the tax losses against the TP adjustment, therefore no additional tax. But with this adjustment made by the IRB, based on the previous regime, IRB has no there will not be any penalty, yeah, to be imposed, because there's no provisions in the law to impose surcharge or penalty on loss-making entity. If you do not have additional tax on the adjustment, there is no penalty. So this is the previous law. Yeah, but starting from 1st January 2021, with the new introductions of the penalty and surcharge, the IRB may impose a surcharge of up to 5% at a 5 million, which is the TP adjustment made by the IRB. Yeah, that sum up to about up to 250,000. And you do not have a TP documentation to be submitted to the IRB in this case, and the penalty will be between 20 to 100,000. Yeah, for each year of assessment. So if the audit period covering 6 years, it will be multiplied with 6, and this is the total potential risk, yeah, for the companies that do not prepare a TP documentation, as well as the adjustment made by the IRB. Okay, so there is also new changes on the disclosure of informations on control transactions sections in the Form C for year of assessment 2022. So most of the companies are submitting their tax return for year 2021, especially December year end will be submitting next month, yeah, which is August, it's the deadline. But for January year end company with January 2022, their submissions for year 2022 will fall in the month of September. So you also have to take note what are the new changes and the disclosure that you need to include, yeah, in the year 2022 Form C. So there are more additional information requested to be disclosed in the sessions for informations on control transactions. So as compared to year 2021, the session is much more simplified. Yeah, that only a few questions, and you will need to disclose, yeah, the transactions that you undertaken with your related parties, whether within Malaysia or outside Malaysia. So these are the disclosure that you need to disclose in your Form C. Yeah. On top of that, there are new additional informations to be included in the Form 2022 to characterize the entity. So you need to characterize your entity if you are a manufacturer, whether you are a full manufacturer, contract manufacturer, or full-fledged manufacturer. Yeah, and distributions entity, as well as any services. Yeah, I will go through further details with you later on. And you will also have to disclose whether there is any business restructuring undertaken, yeah, by the group or the company that impact the characterizations of the entity. Yeah, any R&D activities or intellectual properties undertaken by the company, and cash pooling arrangement. Do you have any dividend payment, permanent establishment, or any cost contribution arrangement that have entered into between the related companies within the group? So this information has been included in the Form C, and you will have to complete this information in the submissions of your Form C tax return for year 2022. So with these additional informations, the impact to the taxpayer is where a greater emphasis on a timely preparation documentation is important, as well as you need to know how to characterize your entity. Yeah, without preparing a documentation or without assessing your functionality, you may not know the type of characterizations of your entity. So you need to be careful. Okay, so under the manufacturing activities, if your company is in a manufacturing business, yeah, you will need to characterize whether you are a full-fledged manufacturer, a contract manufacturer, or a toll manufacturer. So what are the difference between these three types of manufacturers? Yeah, so in terms of production arrangement, Yeah, so for full-fledged manufacturer, usually you will be providing from A to Z, yeah, from productions up to sales, up to distributions, yeah, will be handled by the entity itself. There's a full responsibility of every stage, yeah, whether an IP development, sales, productions, after sales and logistics will be handled by your entity. You can be considered as a full-fledged manufacturer. But whereas if you are your responsibility is a limited exposure to market volatility, and you concentrate more on manufacturing functions for your principal. Yeah, you just get instruction for principal to produce for your principal. You could be classified as a contract manufacturer, or even a toll manufacturer that you don't own any IP, you do not own any inventory, no sales team, yeah, no logistic distributions arrangement for your company. You are just receiving instructions or order from the principal to produce, yeah, on behalf for the principal, and you will probably be classified as a toll manufacturer. So you need to understand your business operations, yeah, in order for you to characterize your entity appropriately. Okay, so if there is a wrong characterization, it can be challenged by the IRB, and adjustment can be easily made by the IRB in this case. Yeah, if you are a distributor, yeah, carry out distributions activities, yeah, you have to characterize, yeah, identify a company, whether you are a full-fledged distributor, a limited risk distributor, or a commission and distributor, or agent distributor, or even a licensed or authorized distributor, like a sole distributor in Malaysia. Yeah, so each of these distributor has different characterizations in terms of their functionality, their risk, as well as the asset assumed by the company. Yeah, so you have to identify, yeah, your company characterization appropriately. So for example, like a limited risk distributor, so in the IRB view, they used to view in the perspective that a limited risk distributor should not be making losses, yeah, and they should have a consistent routine margin to be retained in Malaysia. Yeah, so if your company is being classified as a limited risk distributor and your company is making losses, it can be challenged by the IRB. Yeah, so the IRB want to put this responsibility to the taxpayer to characterize your entity yourself. Yeah, and if there is any dispute in terms of the your entity characterizations, as well as the profit margin earned by the entity, that is where it can be easily challenged by the IRB. Yeah, to scrutinize further, to request further information, yeah, why the company is making losses, or why the company having a low profit margin. Okay, and third is where services. So if the company is providing services, yeah, whether you are a service provider or service recipient, there are difference, yeah, and you need to justify as a service provider or a service recipient, whether you are a management service provider, a IT service provider, or other type of service provider. So this will have to be disclosed in the Form C for year 2022. Yeah. In addition to that, yeah, the entity characterizations, the IRB has also requested the company to confirm whether there's any business restructuring undertaken during the period, during year 2022. Yeah, and this business restructuring may be defined as redeployments of functions, asset, yeah, or risk to which a profit or loss potentially may be attached. So in respect of the business restructuring undertaken by the multinational enterprise, M&E, should not be confused with the ordinary acquisitions of a business or ongoing concern. Yeah, so if let's say the business restructuring undertaken by the group will somehow change the characterizations of the entity, for example, from a full-fledged manufacturer to a contract manufacturer. So this type of business restructuring, you will have to disclose that in the Form C. But if it's just, let's say you are a full-fledged manufacturer, yeah, and you acquire certain business operations within the group, and you are still acting as a full-fledged manufacturer after the acquisition, this probably will not be considered as a business restructuring under this section. Okay, so you have to ensure, yeah, whether there's any business restructuring will change any characterizations of your entities. And the next point is the cash pooling activity. So a lot of companies within the group, they may have this arrangement, yeah, but there's no interest charge. So the IRB will want to know whether there's any cash pooling activities undertaken by the group, yeah, and to see whether there's any interest charge or any transactions between the cash pool leader and the cash pool members. So within the group, often than not, there's many cases that the cash pool leader, yeah, this cash pool leader will work with the members within the group, which we call as a cash pool member. Yeah, so on a overnight basis, all these members may transfer, yeah, their funds to cash pool leader in order for the leader to deposit that into the bank to earn overnight interest. So in this case, cash pool leader will be earning either interest income, or there might be interest expense. If there's insufficient the insufficient fund, the leader may be getting additional fund, yeah, from the bank if there's any deficit, and use it for the group of companies. So in this case, there should be an interest charges between the related companies within the group. Yeah, so this is the cash pool arrangement that the IRB will want to understand whether within your group you provide any cash pool activities within your group of companies. And lastly, the IRB will also wish to know whether there is any cost contributions arrangement, yeah, we call it as a CCA, that enter into between the companies within the group. Yeah, and this CCA is where a contractual agreement between the related companies, yeah, to share resources, to share the cost and the risk in developing or producing or supplying any asset or services, yeah, within the group. So if there is any CCA arrangement, you have to disclose that in the Form C as well. So next update will be on the recent TP audit issues challenged by the IRB. So these are some of the common issues that we encounter, yeah, when we have during a TP audit with the IRB. So these are the three main issues, yeah, the TP audit challenges. The first will be the intra-group services. Yeah, very often that the IRB will scrutinize on intra-group services, yeah, because there are a lot of common mistake, yeah, or dispute with the IRB. The second issue on the intra-group financing, which is where the question has been asked, interest-free advances. This is also very common for group of companies. And lastly is a loss-making entities. Yeah, so among a lot of TP audit cases that the IRB has been conducted during since last year and this year, and we have come across and experienced that most of these cases mostly are loss-making entities. So this is one of the area that the IRB will target on. Yeah, if the company is making losses, yeah, for the past few years, and not during the pandemic year, this can be challenged by the IRB to see whether the loss making is due to your transfer prices, yeah, that you undertake with your related parties. So when we talk about challenge one on the intra-group services, yeah, so there are two perspectives as a service provider or a service recipient. Yeah, whether you are a service provider or a service recipient. As a service provider, you will have to ensure that there are services provided, yeah, to your related companies within the group. Yeah, you can't just charge a management fees, but you couldn't justify what are the services that you provide. So firstly, as a service provider, you need to ensure that there are services being provided and what are the fees, yeah, the service fees that you are charging, whether is it at arm's length and how much is your cost to provide such services. Okay, as a service recipient, you have to ensure and provide supporting to do a benefit test to ensure that you receive the benefit, you receive the services from the provider, and these services is benefit, yeah, your entity, they are of economic and commercial in value. Yeah, so you need to do a benefit test, yeah, as a service recipient, yeah, and to ask yourself how much is the service worth. If you were to engage an independent party, is this the fees that you are willing to pay for? Yeah, and how much will it cost if let's say you were to provide this service in-house instead of getting external party or your related core to provide such services to you. So a benefit is of economic and commercial value if it enhances the recipient's return or profitability or result in cost saving. So if you can justify that if you pay a management fees to your related company or to your holding company, and it helps to provide the services to support your operations, and this help to has a cost saving or maybe operational more efficient for you to focus on your business operation. So these are the justifications to provide in order to pay a management fees on that. So some of the common dispute, as a service provider, that we have come across is where that the service provider provides services, but there's no charges, on the services rendered. So it's a free services provided to the group, but there's no fees being charged. And no proper pricing policy. Some company that we have seen, they just charge a fixed fees, like 1,000 per month, or maybe 12,000 per month, a fixed fees without proper basis, in setting up the management fees charge. So this can be challenged as well. And charges is only to profitable companies and not loss-making companies. So this often we have seen that loss-making companies is not being charged. So long as the company receives the services, that company should be charged accordingly. And reimbursements of costs without a profit markup. This is also very common, that the service provider will just reimburse the staff costs without any markup. This is this is not right. Based on the TP guideline, you should impose a markup on top of the cost, when you charge to your related company for intra-group services. And contract versus actual conduct. So whatever that's stated in the contract, to ensure that the terms and condition is in the contract is consistent with the actual conduct, the actual transactions that you have taken place. If it is not, you will probably have to renew your contract. And there's no benchmarking to support the profit markup to be made. In Malaysia, there's no safe harbor rules. So the IRB would request the company to perform a benchmarking to support any markup rate that you impose on the management fees that you have charged, or any other services that you charge to your related company to support the markup rate. So cost component, this is one of the area in terms of assessing the chargeable cost, and no basis of choosing allocation key. A lot of time the company may just allocate based on revenue. So if for certain services that you provide is not called related to the revenue, this can be challenged by the IRB. So you need to identify the appropriate allocation key for each type of services that you rendered to your related companies. And allocate appropriately, and no calculations to support the charges. So these are the common dispute when it comes to a TP audit. That's where you will have to take note of. As a service recipient, that you pay service fees to your related company as a service provider, you will have to ensure that there's a benefit test. Benefit test to justify their benefit received from the services provided to you. So often than not, we have seen no supporting document for services received. So if you can't prove, and you can't provide any supporting document to prove that there are services received by the service recipient, this can be scrutinized by the IRB. And duplicative services. So if you have an in-house team to perform the services, and you are paying a management fees to your related company for the similar type of services, this can be challenged as a duplicative services. It's not necessary if you have the in-house expertise to perform the work. Amount is too excessive. This can be a area that dispute by the IRB if the amount is too excessive and you do not have the supporting document to justify the charges and the payment. So the appropriate ways to charge in determining the arm's length intra-group service fees, we have come up with this 7-step approach that you can apply in determining the arm's length service fees to be charged for intra-group services. Step 1 is to identify whether a service has been performed, what type of services that you have performed, because different types of services may render a different markup rate. Yeah, so you have to identify the details and the nature of the services, yeah, and how much, how much the value of the services, yeah, for you to perform such services. Step 2 is to identify the benefit to the service recipient. So in providing these services to the recipient, what are the benefits received by the service recipient? Okay. Step 3, to identify and exclude any non-chargeable services. Not all costs can be considered as chargeable costs. So the TP guideline has specifically identified 4 types of non-chargeable services. For example, the shareholders' activities, yeah, duplicative services, services with incidental benefit, and on-call services. So the expenses or the costs that incur in relations to these type of activities is considered non-chargeable services, and you should not be charging those costs to your related companies. Yeah, in details, you can refer to the TP guideline for some examples of what are the costs that involve, yeah, under these non-chargeable expense services. Step 4, once you have identified all this, you have to calculate the pool of costs and determine which cost to be charged, meaning the chargeable cost. Yeah, you need to calculate and identify the chargeable cost that you can charge out to your related companies within the group. And step 5, to identify the cost that could be charged directly versus indirectly. So if you can identify the cost directly to subsidy A or subsidy B, you can charge out directly. You don't have to allocate. Yeah, but if all these costs are considered shared costs, yeah, or common costs that you need to go for allocation, then you need to apply the indirect method, yeah, for those costs that you can't allocate directly to determine an allocation key for charging the indirect cost. So once all these costs has been identified and has been allocated appropriately, then you have to determine the arm's length price by calculating an appropriate markup, yeah, to that. So we call this approach as a cost plus method, yeah, in determining the arm's length service fees, yeah, to be charged for intercompany services. So item 2, yeah, the challenge 2 is on intra-group financing. Yeah, we call as a intra-group financing, where financial assistance provided between the related companies. So if you are a lender, yeah, you provide a fund or a loan, yeah, to the borrower within the group. Yeah, you need to ensure there's a arm's length interest rate to be charged. Okay, lender will receive an interest income, and borrower you have an interest expense. So for this interest charge, yeah, on intra-group financing, yeah, based on the guideline, yeah, you have to determine the base, yeah, which is the reference rate. So this common base or reference rate can refer to average lending rate, yeah, ALR from Bank Negara, base lending rate, yeah, from Bank Negara as well, KL interbank LIBOR rate, or interest rate on bank borrowing charged to the lender. Yeah, let's say lender, you borrow the fund from the bank, that is where we call as a cost of fund, yeah, of the lender. So you need to identify the base rate, yeah, first, and then apply a credit spread, which is a margin to be applied. Yeah, and this spread require a benchmarking study based on external comparable data and the determinants of a margin and credit spread. Yeah, that will based on various comparability factors. So all these comparability factors will be considered, yeah, when setting up this interest rate. Yeah, whether what is the nature of the intra-group financing and its purpose. Yeah, what is the amount, duration, and terms. All this will affect the interest rate that you determine. Yeah, what type of interest rate, whether it's a fixed or floating rate, any embedded options, any guarantee involved. Yeah, is there any collateral involved? What is the credit worthiness, yeah, of the borrower? This is also important. And what is the location, yeah, within Malaysia or overseas? Sometimes in different currency, loans will also subject to different interest rate. Okay, so a lot of dispute on this intra-group financing that we find within a group of company is interest-free loan. Yeah, a lot of time this intra-group financing being provided within the group, there's no interest charge. Yeah, if there's no interest charge on the intercompany loan that you provide, this may not be regarded as compliance to the arm's length principle. Yeah, because the arm's length principle said that a provisions of financial assistance should be subject to an interest charge. Yeah, so some common dispute is that no loan agreement, yeah, that enter into, no basis of charging. Yeah, some company charge a fixed FD rate. Yeah, and you just impose a interest rate without any basis to that. No comparability analysis to support the interest rate. Yeah, okay, charge at a fixed FD rate. So IRB has also commented that FD rate may not be suitable. Yeah, because this is this financing and funding is considered a lending. Yeah, so you should refer to a lending rate instead of a fixed deposit rate. Okay, and low interest rate charge. So if your interest rate charge is too low and you couldn't justify, yeah, the interest rate unless a bank is charging the similar interest rate, yeah, similar low interest rate to your entity, and you are imposing the bank interest rate, then you could probably justify from that. Yeah, but otherwise it may be challenged by the IRB. Okay, recovery of a cost of fund without any spread, you just do back-to-back arrangement. Okay, base reference rate without any spread, this is back-to-back. Okay, charge to profitable companies and not loss-making entities, yeah, very common. Long overdue amount owing balances, yeah. So some of these amount owing balances sitting, yeah, in the balance sheets of the company may not, the nature of these amount owing balances may not be a loan in nature. Yeah, some could be payment on behalf or long overdue transactions that you have, yeah, but it's not being settled off, so it's considered as a non-trade, yeah, in your amount owing balances. And if this long overdue amount owing balances sitting in the book, it can be considered as an advances, yeah, to your related company. So this can be challenged by the IRB if the amount is significant, and the IRB may impose, yeah, an interest on the long overdue amount owing balances. Okay, and corporate guarantee as well. So corporate guarantee also fall within the definitions of a financial assistant, yeah, that subject to guarantee fees or interest to be charged. Yeah, but you have to look into the transaction, yeah, to see whether is there interest should be charged on corporate guarantee. So I just give you a 3 example, yeah, on how to determine, yeah, the appropriate interest rate, yeah, to be charged. These are just some example that we can share with you, a simpler method, yeah, in dealing with intra-group financing. So for example 1, okay, lender provide an intercompany loan to the borrower, yeah, and this fund from the lender is sourced from the bank. So the lender obtained the fund from the bank, yeah, and bank charges an interest to the lender, we call it as a cost of fund. So this fund will then sublend it to the borrower, yeah, as an intercompany loan. So in this case, you have to recover your interest expense that paid to the bank, which is the cost of fund. Yeah, you have to charge at least, yeah, the cost of fund that you have to pay to the bank. So the interest rate that you can charge to the borrower, yeah, you can base on this method as a cost of fund plus a spread. Yeah, why do you need a spread? Is that as a lender, you will bear the financial risk. Yeah, if the borrower doesn't pay you, you still have to pay to the bank. So this is the financial risk that the lender will bear, and some of these administrative expenses that you will incur in obtaining the loan, yeah, from the bank. So this spread is meant to cover all the costs and the risks, yeah, of the lender, to be borne by the lender. Yeah, so you can't just charge back to back, but a cost of fund plus the spread, a markup, yeah, to the borrower. So for example 2, if the lender provide the loan, yeah, to the borrower based on internal fund, there is no external bank loan, yeah, it's just based on internal fund that the lender provide debts to the borrower, and what is the appropriate interest that you should charge. So you have to look into the borrower perspective, yeah, whether there is any external bank loan from the borrower. Let's say the borrower has also obtained external bank loan from the bank, and how much is the bank charging to this borrower. So that could be an arm's length rate, yeah, that you can make reference to yeah, given that the terms and conditions, everything is similar, then that will be the comparability rate that you can apply. Yeah, so if the interest rate from the lender to the borrower, yeah, you can apply the borrower bank borrowing rate, yeah, as the reference rate, because the bank would have assessed the creditworthiness of the borrower in order to provide the fund to the borrower. So if the bank willing to charge, let's say the bank charges 6% on the interest rate to the borrower, that 6% could be considered as an arm's length or comparable rate. Yeah, and that is where it deals with the external bank loan. Okay, so this is example 2. Example 3 is where there is no external source. Yeah, lender provide a loan, yeah, to the borrower with his external internal fund, and there is no external bank from the borrower. And how would you assess, how do you determine the interest rate, the arm's length interest rate for this intercompany loan? Yeah, so the interest rate, yeah, a simpler way is to make reference to the bank negara average lending rate or the base lending rate. This is a straightforward method that some of the IRB officer, yeah, may apply this method in making adjustment on interest-free loan. But more appropriately, if you refer to the TP guideline, yeah, in a more appropriate method is to determine the credit rating of the borrower, yeah, to determine the arm's length interest rate. Yeah, because the interest rate will varies, yeah, depending on the credit rating of the company. So if the company is being rated as a triple A, yeah, A plus or triple B, so the different rate may apply, different interest rate may apply. Yeah, so this is some of the example that you can make reference to in setting up your interest rate. But of course, interest-free is not appropriate. Yeah, I would say it's not considered as compliance with the arm's length principle. Yeah, unless you have strong justification to justify that that is not a loan, that is not a financial assistance, that's not a loan, and it is a equity. Yeah, that is where you can defend your positions for not charging an interest. Yeah, otherwise it will often be challenged by the IRB. So challenge number 3 that the IRB will often raise is loss-making entities. Yeah, that the IRB will usually assess, yeah, company with loss-making because these are the companies that can be easily make adjustment by the IRB. So if we base on the benchmarking result, so when it comes to loss-making entities, often than not, the IRB will make a TP adjustment to adjust the losses, yeah, of the company to the median of the benchmarking result. So this benchmarking result is a pool of comparable companies that are undertaking the similar type of business activities as your entity. So the IRB will prepare, yeah, or even when you prepare a TP documentation, this benchmarking analysis would have been performed. Yeah. So based on this benchmarking analysis, yeah, the IRB will assess, yeah, what are the profit margin that earned by your comparables companies undertaking the similar type of business activities. So for example, if you have a set of comparables companies that generated this result, the benchmarking result, yeah, we call as the interquartile range, for 18, 19, and 20. Let's say the median is 9%. So in the year of 18, your result, your taxpayer result is 10%, which is above the median, is fine. IRB will not make adjustment. So IRB will usually make reference to the median point, yeah, when making adjustment. So if in the year of 2019, your margin has dropped to 5%, and this 5% is below the lower quartile, yeah, this can be challenged by the IRB because your margin is not within the industry range. Yeah, that the IRB will make adjustment from 5% to 8%. So this is their practice. In year 2020, you remain your result, the financial result of your company dropped further to 3%. But because the overall economic has been, is during the pandemic year, overall industry result has dropped as well. So your 3% is still fall between, below the median, yeah, but it's between the interquartile range. Yeah, so in practice, IRB may still make adjustment from 3% to 4%. Yeah, so that is where IRB will adjust to the median. This is their practice in carrying out a TP audit. But in this case, there's a case law, SEO Sdn Bhd with the IRB at High Court that's being updated just 2 months ago. On 17 May 2022, 2 months ago, the court has ruled that the IRB did not have the legal right to adjust the taxpayers' profitabilities to the median. And as long as the taxpayer margin fall within the inter-quartile range from lower to upper quartile, so long as your result fall within the inter-quartile range, it should be acceptable. And IRB has no right to make adjustment to just 1 point at the median. So this is the court decisions, but in practice, IRB will still make adjustment to the median point, to determine the arm's length price. So this is the practice and the law, by the court. But you have to take note, if any of your results fall below the median or fall outside the interquartile range, you have to justify, with a commercial reason, what is the reason for the companies making losses. So some of these special factor analysis, or we call it as a justification that you can put through, whether it's a quantitative analysis or it's a qualitative analysis, especially during the pandemic year. So if let's say your operation is being affected, at a below optimum productivity level, or sudden drop in the demand in the market, so you have to provide all these supporting, with justification that the profit margin of the company reduced significantly or even making losses is due to all these commercial reason. And not only explaining the reason, you should also be quantifying it, to provide some numbers, your production's value, your sales value, your production's capacity, to justify that the company is not doing well during that year, to ensure that this can be supported, with a commercial reason. Okay, so just now when I explained this court case, which is Sandakan Edible Oil, Sdn Bhd, with the IRB. So the case was initially being filed to the Special Com of Income Tax, SCIT, in the year of 2021. There is a published, for this court case, where SEO, in short I call SEO, is a refining company principally involved in selling cooking oil and related products. So IRB conducted a TP audit for a year of assessment 2010 to 2013. There's a sales of product to the overseas related parties as well as third parties. So in the key summary here is that SEO prepared a TP documentation and submitted to the IRB during a tax audit, and the company applied the TP method of comparable uncontrolled price method, which is a CUP method, because the company transact with sell to related party as well as selling to third parties. So the company has made use of a CUP method, to benchmark, to compare the price that they sell to related party as well as a third party, or the commodity price as well. The IRB disagree with this TP method applied by the company. The IRB rejected the CUP method and directed the taxpayer to prepare a benchmarking analysis using the transactional net margin method, TNNM. So the IRB wants to use a TNNM, and they say, okay, CUP method is not appropriate in your case. You should not apply CUP method. You should apply TNNM to test the arm's length of the control transactions, on this intercompany sales. So the taxpayer did not deny their CUP method, but to comply with the IRB direction, both the IRB and the taxpayer agree, to a final list of 6 comparables companies operating in the oil refining business for 2010 to 2013, for the year's audit period. So for year 2011, 12, and 13, the taxpayer achieved a profit margin which is above the median point. So just now I show you, this is the benchmarking result. So for year 11, 12, and 13, the taxpayer achieved the result which is above the median point. So no adjustment by the IRB. Okay. But however, for 2010, the taxpayer profit margin fall below the median of the range, the result, but within the inter-quartile range. So the IRB disagreed, yeah, on this, because in 1 year, the profit margin fall below the median, and the IRB make adjustment on this profit margin for 2010 to the median point. Okay, that's where the price charge on control transaction is not at arm's length. So in this case, additional tax has been imposed by the IRB of 8.5 billion, yeah, in year 2010. Yeah, year 11, 12, 13, they fall above median, no adjustment to be made. So during at the special com level, yeah, the judge do in favor with the taxpayer, and the taxpayer has won the case that the IRB has no right, yeah, to make adjustment to the median. So long as the margin fall within the interquartile range, it should be acceptable. Yeah, and this is also and mentioned, yeah, in the OECD guideline. It should not based on what the IRB practice. Yeah, so IRB is not satisfied. The IRB appeal further to High Court, yeah, for this case. So the High Court decision has been made on 17 May, yeah, 2012, where the High Court dismissed the IRB appeal and affirmed the special com decision. So the High Court decisions confirm, yeah, the following few key points, yeah, for the taxpayer for TP matters. Under the OECD guideline, remain the point of reference for TP matters in Malaysia and cannot be ignored in a TP audit. So IRB ignore the OECD guideline and they make adjustment to the median. Yeah, so the judge, the court, High Court said that you cannot ignore the OECD guideline, and IRB does not have the unfettered discretions to make TP adjustment under Section 140 capital A. So OECD guideline must be duly considered and applied for matter not specifically provided, yeah, in the Act or the TP rules. So again, OECD guideline cannot be ignored. So you have to follow that as well. Taxpayer in this case has prepared a good and complete TP documentation to support the transaction, because this has always act as a first line of defense for the taxpayer. Okay, and the importance of proper documentations, the court hesitate to accept oral evidence. So if you have all the justifications, yeah, for your company, you have to keep all the proper supporting documentation, because verbal explanation and evidence, oral evidence, is not sufficient. Okay, especially it does not accord to the contemporaneous written evidence. So this apply equally to taxpayer and IRB. So if IRB do not have a proper supporting documentation to justify the adjustment, that can be challenged in court as well. Okay, and the interquartile range is recognized internationally as a suitable determinant of the arm's length pricing. So therefore, where the taxpayer's financial results fall within the arm's length interquartile range, it should be acceptable and no adjustment should be made. So this decision has been made, yeah, favorably to the taxpayer. So key takes away before I end the sessions to a Q&A sessions. Key takes away, a few key takes away for the participants today. Okay, please ensure you prepare a good quality contemporaneous TP documentation. As I mentioned, this act as a first line of defense, yeah, for the company during a TP audit. Yeah, so if you do not have a TP documentation to defend your position, it is at a weaker position that it can be challenged. Yeah, if the IRB make adjustment, it's difficult for you to defend for yourself. Okay. Second, importance to ensure consistency between the taxpayer responses to the IRB officer during an interview sessions and those informations documented in the TP documentation. Yeah, to ensure that whatever has been documented, this is what you have been transacting, and to the person that is answering, yeah, to the IRB. So selections of comparable companies in performing the benchmarking study is also very important, because the IRB will make use of the benchmarking result, yeah, to make adjustment. So selecting the comparable company is also important, yeah, when to derive the profit margin or the interquartile range, yeah, for the benchmarking result. So to ensure documentary evidences are kept properly, yeah, as this may serve as a persuasive evidence to further support the arm's length nature of the related party transaction. Yeah, a lot of cases that we find that the IRB can easily challenge on the taxpayer is where they do not have sufficient documentation. Yeah, so if you do not have a sufficient documentation, that's where it's difficult, yeah, for you to defend your positions and appeal to the IRB. Okay, and lastly, be cooperative with the IRB and submit the TP documentations and all the supporting documents requested by the IRB on time during an audit process, because this gives a better ground for a taxpayer to appeal for a lower penalty rate. Yeah, so this is also very important when it comes to a TP audit. So I guess I have done my briefing right up to these sessions. So we can move on to a Q&A session if there's any question raised by the participants.
No, none at the moment. So you continue with the ones that has been asked prior, was it?
You mean the two questions that has been...
You answered already, right? Is it?
Yes, I've answered the two questions.
Okay, all right,
yeah.
all right, okay. Yeah, I didn't really see any questions coming in, but there's a few things that I didn't notice in terms of this SEO court case. You know, you're talking about the legal fees that the SEO had to go through to hire you know, consultants like yourself and then lawyers to go and challenge, you know.
Yes.
It really becomes something which is quite negative, right? Because the IRB doesn't cost them anything, you know, they'll just continue to do so, right?
Yes, I think in a lot of cases, taxpayer try not to bring the case to court because firstly, it will incur additional cost by hiring consultants or maybe the tax lawyer. Secondly, it may have some disruptions to the operations, because the court case, it will not be settled within 1 or 2 months. It will take some time to come to a final settlement. Or to get decisions from court. So it takes a longer time to that.
And then when you mention things like the comparable benchmarking, if not mistaken, some businesses they use a business association to come with the benchmarking, because you know, if you try to get such benchmarking information from your competitor, it's going to be a bit tough, right?
Yes,
so I think most of them do use a business association, and a business association actually sets some of this benchmarking. Have you seen this before? Yes.
Yes, in order for us to perform the benchmarking study, in fact, in the guideline, we have it has also clearly stated that those information should be used publicly available. So if the information that you use to compare is not publicly available, that information may not be acceptable to the IRB. So in most cases, when we perform the benchmarking study, we base on a database to search for those comparable companies that are undertaking the similar type of business as your entity, based on the MSIC code of principal activities, and we check through their company website that are undertaking the same type of activities, and we'll get their financial data, and to analyze the financial profit margin of the entity. So we are not actually getting the selling price or the price of the product to compare with your selling price. It's actually on an overall basis, how is the company's earning, the profit margin of this type of companies undertaking the similar type of business activities.
Okay, right. Just a bit of sharing. I used to do treasury function for a corporate with many subsidiaries. So what we do is, like you mentioned earlier, is the pooling of funds. Okay. So there is a in and out. There are if the subsidiaries have excess cash, then I'll sweep them into my treasury. And then if they are, let's say, in need to pay payroll or something like that, then there's a negative. Then I will push cash back over to them. Right? So this is the treasury function. The problem we have here is that when we are in cash positive, then we will place overnight, right? Overnight money markets, and then we get some revenues from the interest. Alternatively, the other way is that sometimes there is a negative cash flow, then we will take from again over the money market to be placed, right? So there's an in and out, in and out.
Yes.
Yeah, from the point of the treasurer. Okay. Now the problem is at the end of the month, because we can't, you know, at the end of the month, or at the end of the day or whatever, likely to be, I remember was end of the month. So there's a net positive or net negative because of the money in and out. Okay, so that net difference, let's say it's a negative. Okay, then what we want to do is we will reallocate the interest paid or the net interest paid back into the subsidiaries.
Yep.
Okay. And then so the point here is like you say there's a calculation of financing, the transfer pricing and interest rates and stuff like that. You know, it's very difficult, you know, because it's a daily movement.
Yes.
You know, you borrow some, you give us some, etc. So what we did was we took let's say an average asset or funds position that they had, and then we allocate based on that. So would that, in your mind, be acceptable by the IRB?
I would say that will be one of the basis, that you can apply, because it's not sometimes it's not appropriate to do overnight. Every day you calculate the interest and then back charge to all the members within this group. But what you have explained just now, it can be one of the method, that you calculate based on the monthly basis, at the net level, and distribute back to the respective members. But the thing is that the applications that you are doing right now is back to back. So whatever that you earn from the bank, you will then distribute down to the subsidiaries, let's say subsidiaries within the group, and you earn nothing. So in this case, as a treasury management, you should be charging a fees, a service fees for handling these treasury management activities. So it's either you increase from the interest charge, let's say whatever the bank paid you, you have this, and you add a markup to that, or there should be a separate service fees as you perform these treasury management services.
Right. Because sometimes that treasury management fees goes into something called a management recharge that includes group marketing, group IT, etc., right? That's another different story, right?
So if you have a separate charge on this management service fees, to the subsidiary, that can cover the functions that you perform. That should be fine.
Right. Okay. Right. So a question that came in, saying that what's the position? This was asked the last time too. That you have seen in IRB's practice or point of view on corporate guarantees extended by a holding company to its subsidiary within the group. Instead of actually cash lending, is a corporate guarantee.
Okay, this is a difficult question. So far from my experience with the IRB, some of these corporate guarantee may not be challenged by the IRB, because sometimes, all this corporate guarantee may not be disclosed, in the audited accounts, and IRB may not find out there's a corporate guarantee in this arrangement, because usually corporate guarantee will not be recognized, in the balance sheet or a P&L. So often than not, the IRB may not know there's a corporate guarantee. But for public listed core, a lot of time, this corporate guarantee will be disclosed, in their audited report. That's where the IRB may questions further the usage and the nature of this corporate guarantee, whether it give a benefit to the service recipient who received this corporate guarantee from holding core. So you have to assess whether there is any benefit they receive. Let's say I give you a very simple example. If let's say with this corporate guarantee, the subsidiary can obtain a loan from the bank with a lower interest rate. So in that case, there's a benefit received, yeah, by the subsidiary. So without this corporate guarantee, the interest rate will be higher. Yeah, so in this case, if there's some saving, yeah, that's where the IRB was saying that you should pay a guarantee fees, yeah, to the holding company for providing you, because you enjoy the benefit from that. Yeah, but as I say, a lot of cases, corporate guarantee may or may not be challenged by the IRB, because to the IRB, they have no proper guidance in how to determine the guarantee fees. Yeah, so this is one of the issue that is not commonly raised by the IRB at this point of time.
All right. Okay. Great answer, because that was also something that was in my mind about this, and it's also got to do with sometimes the subsidiary or vice versa does not have a good corporate rating, so to speak, credit rating, and then it's borrowing using someone else, another subsidiary or associated company's credit rating to actually borrow, and then internally then lend over to the other one, right? And then that also may justify the spread, right?
Yes.
Like you say, to compensate for poor credit rating, my spread is higher than normal. Yeah, and it's acceptable, right?
Yep.
Yeah. Okay. Well, last one is just about asking the presentation slide. I guess if you need to, just contact Crow themselves, and you can see it from here. Is there an email address or something like that can contact you?
Yeah, I think you can scan.
slide?
Yeah, for the billing, for the email, I think you can scan the QR code for the email contact. Yeah. Basically, I think for general or complimentary briefing, we do not provide this presentation slide because it's live streaming as well. So we don't provide this presentation slide.
Correct.
Yeah, but if you have any questions, you can always come to us and email us.
Yeah, it's fair enough, right? This is a proprietary for you guys, right? If you really need some consultation, now just give them a call, and have a chat, right? Okay.
Yep.
All right. Okay, so you have already shared some takeaways. Prepare your TPD, don't resist, to be honest. Don't give a bit resistance or impression that you were trying to avoid anything. Like anything else, is very psychological, right? Okay, right. Okay, so thank you very much, Sylvia, and for those that has stayed on to listen to this, I can try to get around your head. All these new things that's coming through is getting more and more onerous. Please do have competent consultants that you can refer to, and that's something that MICCI is sharing together with Crow. And go and talk to them if you have some worries. Don't worry about it. Yeah. Okay. Great. Just stay tuned for more things to come. See you guys next time. Right. Bye.
Thank you.
Bye. See you guys.
Yeah. Take care and stay healthy, everyone. Goodbye.